Hi, today we will be discussing a very important topic. What are the objectives of a business firm? Why does a business firm exist? What are the principles which should guide the decision making of managers in a firm? These questions lie at the very foundation of capitalism and determine, in a way, various schools of thought when it comes to defining what version of capitalism should exist. As a manager, of course, these questions are quite important because if you don't know where you're going, it doesn't matter how you get there and when you get there. So, if you don't know the end objective of your decisions, the tools and techniques you use for decision making don't really matter. The background of our discussion is a statement released by the Business Roundtable, which is an association of 181 top CEOs in the United States. And it came very recently in August 2019 when they said that maximizing shareholder value and maximizing shareholder profits are no longer seen as primary goal of corporations. And of course, such a large group of CEOs making this kind of statement definitely made the news. Right? And so we will try today to see some of the nuances related to this announcement and some of the concepts involved in this discussion. Let's begin by discussing the various stakeholders which a company has to manage. These are basically all the people who are affected by the different decisions which a company has to make. There are 7 key stakeholders of any company. Let's start with the shareholders, also called stockholders, who invest in equity and own the company. Then we have the banks and bondholders who lend to the company either as loans or via market securities like bonds, debentures, commercial paper, etc. The third group is the employees who work for the company. Of course, one of the most important stakeholder groups for a company is its customers who buy products and services from the company. Then we have competitors who are other companies who sell similar products and services in the market. And finally, there is society which receives certain benefits from the company like employment generation, but also faces certain costs. Every business, no matter how well run, creates costs for society. And this is an important point to understand. Some companies create huge costs like pollution, which leads to problems related to climate change. But even very small businesses create costs for society. As an example, I used to live in front of a very famous mithai shop in Thane, and it used to create a huge amount of traffic in front of the shop. All day long, we used to hear cars honking, and this is a social cost for people who live near the shop. Finally, at the center of this field, we have the managers who run the company and make several important decisions. Now, in theory, shareholders exercise control over managers by appointing board of directors and using other mechanisms like annual meetings. However, we'll of course discuss how it usually tends to play out in practice. A key feature of the structure of modern corporations is that while shareholders are the owners, they have a residual claim on the company. What it means is shareholders get whatever is left over after the company pays all its other obligations. And it is this feature which makes equity a very risky asset class. The lenders usually lend to the company at a particular interest rate, and this interest rate is supposed to reflect something called the default risk of a company, the risk that the company may not pay this money back. The loan contract usually also involves certain clauses which are called debt covenants. They restrict the company from making certain decisions without the permission of the lenders and also gives the lenders veto power on certain specific actions. Employees, of course, receive wages and benefits based on market conditions, but it is also dependent on their own negotiation skills. Now, when it comes to customers, they have a lot of power. If they like a company's products and services, they can come back to buy more. Right? If not, they can return the company's products or shift to a competitor. This is, of course, assuming that there are several competitors and customers actually do have several options. Competitors, of course, compete in the market for market share using several strategies. And finally, economies live in societies. A company has to be aware of and follow the laws and norms which are considered acceptable by society. This discussion is closely connected with the concept of corporate governance. which discusses the different principles and mechanisms by which companies are controlled and operated. It lies at the intersection of three topics: finance, which is part of management, law, and politics. While most of our discussion will revolve around financial considerations, it is important to take into account what is the current legal status and which way the political environment is swaying for managers to make effective decisions and fulfill their responsibilities. This view also helps us analyze and put into perspective real world events like the announcement by the Business Roundtable. It also helps us understand what are the implications of such events. With that, let me introduce what traditional corporate finance theory says about the objective of companies. We will first engage with the theory and the common objections of its most vehement opponents before we move to a more balanced discussion on this topic. When it comes to defining an objective, there are 5 things to keep in mind. The acronym SMART is a good way of remembering the characteristics of a good objective. A good objective should be specific. We should know what we are talking about. A common example of a vague objective is, let's maximize growth. But growth of what? Revenues? Net income? We need to be specific. The second feature is it should be measurable. If my goal is to maximize the happiness of my employees, how do I know it is achieved? Is there a happiness thermometer I can use? Third, the goal should be achievable. I cannot set an impossible objective for myself, or I cannot achieve something which is not necessarily in my control. As an example, if a company says I want to maximize India's economic growth, it is not in the company's control to do so. So it might be useful or it might make sense from an ideal perspective, but it has very little effect on the day-to-day practice of the company. Fourth, the objective should be relevant. If I am a business, the objective should be relevant for what I do. If I sell mobile phones, the objective for my company cannot be that I want to maximize world peace. And finally, any objective should be time bound. Maximizing long-term growth is a very vague objective. What does long-term mean? 3 years? 5 years? 10 years? Finally, any objective that a company has, it should not create costs for other entities. Take the example of a tobacco company inclined to advertise to teenagers and children because its objective is to maximize revenues. Now, there are a lot of people who might disagree with the inclusion of social costs and argue that a business only has a responsibility to its stockholders, but this is extremely short-sighted. Remember that you cannot ignore all the other stakeholders and expect to keep running a business which creates large costs for them. Sooner or later, it will catch up to you and destroy value for the business. So, what does corporate finance theory say about the objective of a business firm? The most general objective function you can have is to maximize the value of the firm. 2 points are important to keep in mind when it comes to maximizing value. What is good for the firm may not always be good for society, and hence a firm will face trade-offs while making decisions. Second, it is difficult to accurately estimate the value of a firm. There are a lot of subjective inputs, and more importantly, there are several variations and disagreements when it comes to defining what value exactly is. This leads us to a narrower objective: maximize stockholder wealth instead. Since stockholders own the company and are supposed to be in charge of the managers, it makes sense to target this objective. However, interests of stockholders and lenders are not always aligned. It is important to remember this and to ensure that they are reconciled. However, this itself has a problem. Estimating stockholder wealth in an accurate way is also difficult, requires expert inputs, and could lead to disagreements. There is also a question of reliability, since managers would be inclined to overestimate stock wealth. Thus, an easier metric to look at is the stock price, which would be considered an accurate estimate of stockholder wealth if the stock is traded and the markets are efficient. Now, since this is a third party estimate of the value of stockholder wealth, it could be considered more reliable and might lead to lesser disagreements. However, it is important to remember that markets have been known to be inefficient, biased towards the short term, and regularly go through periods of irrational booms and busts. This could lead to inaccurate estimates of stockholder wealth and could cause managers to make the wrong decisions when it comes to allocation of resources. I want to introduce a framework here which is quite useful in thinking about a firm from the finance view. It's called the financial balance sheet. Like an accounting balance sheet, it has two categories of items, the assets on the left side and the liabilities on the right side. An accounting balance sheet is largely backward looking, focuses only on assets in place, and measures almost all the variables in terms of their book value rather than the current market value. Right? So as an example, if I bought land 20 years ago for 100 rupees and today it is worth 50 lakh, a typical accounting balance sheet would still show it as 100 rupees. As opposed to that, a financial balance sheet is a forward looking, it measures variables in terms of their market values and talks not only about existing investments but also the expected value of future investments. So think about early stage startups with $1 billion valuations. Most of their value comes from growth assets, which are investments expected to be made in the future. Now let's map the three objectives we discussed earlier on the financial balance sheet. Maximizing firm value corresponds to maximizing the value of assets. As we discussed, this is difficult to estimate since we would need to estimate value not only of assets in place but also growth assets. Thus, if it is assumed that debt holders are able to protect themselves by negotiating suitable contracts, managers can focus on a narrower objective, maximizing stockholder wealth, which in this case is the value of equity. And if the stock is traded and we assume that markets are efficient, managers can maximize the stock price since it would accurately reflect the value of equity. Note the two assumptions that we have made here to move from maximizing firm value to maximizing stock price. One is that debt holders are able to protect themselves using contracts and other mechanisms. And second is that financial markets are efficient, that they accurately reflect the value of equity. Now, the one question arises here, which is very commonly asked, is if managers focus only on maximizing the interests of one group of stakeholders, which is the stockholders, isn't it possible that they would ignore the interests of all other stakeholders? Wouldn't they rip off customers, harm society, exploit employees, and avoid repaying lenders? The answer is absolutely. This is quite possible. So let's look at the absolute worst possible case where it could lead us. Let's call it cutthroat corporatism. This is the most commonly used scenario to oppose the view that it is a bad idea to focus only on stockholder wealth. In this scenario, the firm is largely owned by a small number of founders, family members, or investors who focus only on maximizing their own wealth and don't care about anybody else. Managers cater only to the interests of this founder group. Lenders do not have enough power to impose any restrictions. Employees are underpaid and exploited. Customers pay higher prices. There is hardly any competition in the market, and the society bears large costs while receiving few benefits. This is the corporate finance theorist's worst nightmare. Because if this is what happens when you maximize stock price, it is indeed a very harmful objective. So before we go into a nuanced discussion about whether maximizing stock price is a bad idea, let's get rid of some myths and false choices. Some very commonly asked questions are, do you want to take care of your employees or do you want to make profits? Do you want to satisfy your customers or do you want to make money? Now these questions involve the portrayal of choices which are inherently false. And let's talk about why. Think about employees and ask yourself a question. Would you rather be working at a financially healthy company or would you prefer working at a loss-making company on the verge of bankruptcy? The key point is that maximizing stock price is not inherently incompatible with meeting employee needs. For example, in many firms, especially startups, employees are often stockholders and benefit from an increasing stock price or an increasing stockholder wealth. It is also generally true that profitable companies are able to treat their employees well and usually do that consciously to attract the best talent in the market. Think about customer satisfaction. Often, customer satisfaction and happy customers are a key factor in driving profits. And the same goes for society. A company does not have to be a social outlaw to make money. Now, what is the learning? Since there are several stakeholders of a company will face trade offs. But the key point is that the interests of different stakeholders are not inherently mutually exclusive. So now we have two views at opposing extremes. One view says the objective of a business should be to maximize the interests of all stakeholders. The other view says, which is proposed by corporate finance theory, that the objective should be to maximize stock price and that a firm should care only about its stockholders. What we will do going forward is discuss how both these views are problematic and flawed because they come from idealistic notions. We will bring in aspects of the real world and discuss which solutions make sense from a practical perspective.